Hello, guys. Welcome to my daily brief on the economy. Today, I'm going to be talking about two issues that have been topical, kind of related though, but two different issues. The first one is on an agri-tech company that I'm sure if you've been following social media briefings, you would have been seeing, chatter about, people complaining bitterly about them not being able to receive their money. Apparently, that agri-tech company is called Agric. Interestingly, that's actually one of the reputable agri-tech companies out there. But they found themselves in hot water, social media hot water, and they were being dragged. When they say you're being dragged on social media, it means that everybody's coming after you, coming at you from a negative point of view. And it all started with a Twitter user who complained that he hasn't gotten his 1 million, he or she, that invested through Agric, and Agric is saying that, look, we can't pay you right now because we're having challenge. And then the guy went on social media and just poured out his outrage, and that basically has just opened a can of worms that is likely going to affect other agri-tech companies now, because now people are now looking at agri-tech companies with a high level of skepticism. So what exactly happened? So the guy invested to Agric and couldn't get his money back, and Agric is saying, look, things went bad because of COVID-19. We couldn't get our money out from the farmers, blah, 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 blah. Bottom line, we can't pay you. And the guy's furious. I thought you said these things were insured. And then people now started dragging in the insurance company behind it. And the insurance company came out and said, hey, wait a minute, we never said we're going to insure your money. What we only insure is the farm produce, or, an aspect of the value chain. So, the way insurance works. So, maybe they're not going to insure your own direct money, but they will insure an aspect of the business. It could be, if the plant, say, corn, and then you harvest 100% of the corn, but maybe down the line 20% goes bad. So maybe they are insuring that one, 20% that went bad, or 50% of the 20%. So the funny thing with insurance is that you're not really clear what they're insuring. It all depends on what you're paying premium for, and a lot of these things are not clearly, spelled out or told to customers or to investors. And so, but the company Leadway Assurance came out and said, look, we don't insure you, your payment, your losses. What we insure is the other side of the value chain. And that just throws into, brings into the fore the challenges you have with investing. And I've told people several times, there is no risk-free investment out there. The only risk-free investment is FGN bonds and treasury bills. That's the only risk-free investments. And these days, they're not that lucrative anymore. So they don't pay you like 12, 13, 14% that they used to pay some years back. It is now 3%, 2%, 4% max that you get from from treasury bills. FGN bonds, if you're lucky, maybe 5, 6%. So they don't pay that much anymore. So if you're looking for investments that pay you double-digit returns, you've got to be able to take some risk. So when you see all these agri-tech firms tell you 20% in 6 months, and the way they advertise this thing, 20% in 6 months, sold out. And then when you see sold out, you're like, God, I've missed out on something. It's good, but it does come with some risk, because they are investing in a very risky business, which is farming. So there's every likelihood that you might not get all of your money, or maybe you get part of your money, or none at all. So you gotta understand what you're getting into, right? So don't think it's a risk-free investment. It isn't at all, and it's likely that you could lose some of your money. So you've got to understand that part. And even if some of the agri-tech firms don't clearly tell you, don't believe the hype. It's not foolproof. They don't have there's no 100% guarantee on your money. And even when they say there's 100% guarantee on your money, I doubt it. Honestly doubt it, right? It could turn out being, getting you in a loss position. Understand that when you're investing in anything other than treasury bills or FGN bonds. That's investing. Nigerians sort of believe that when you just invest, your money must come back. No. Same thing, you invest in the stock market. There are no guarantees. That is why you need to understand what you're investing in. And like I've said several times, if you decide you want to go into mango business, you want to be selling mango, you know that there's no guarantee that you make your money back now. Yeah, of course, your mangoes can spoil or you might not have anybody buy it. So everything has its own risk. You understand the risk and the return dynamics so that you know whether it's worth investing your money into. And what's important about investing that I talk with a lot is always invest in things that you can get your money back without anyone. Which means invest in products that have a market. The worst that can happen is that you won't get all of your money, but at least you can get some of your money back. Those are the kind of investments you should always look out for. Very important. Liquidity is important in investments because when it starts to go bad, you can easily just get out of it. The worst case is that you just take on some losses. But don't go into investments that it's not liquid. You're not sure you can get a buyer. You're not sure you can sell. You don't own control of the value chain. Make sure that the kind of investments you do gives you control of the value chain. You have a market that you can flip. And there are a few out there. There's the bond market, if you have deep pockets. There's the stock market. And then even cryptos. Cryptos, you can sell your cryptos. You don't need anybody. Just go into the crypto exchange and sell. Okay, so that's it for Agritech. And I think Agritech firms very soon are going to also develop into some kind of exchange where you can just sell without needing anyone. So like if you had invested in this Tribe Agric thing and down the line you're not happy with what their returns or how they're doing, you can just sell it and take your money and move on. You don't need to call anybody or go on social media and start to rant. No, just do your thing and go. Second part of my brief today is on the stock market, by the way. So if you've been noticing, the stock market has been booming. It's been like stocks have basically been off the chains, right? I'll give you an example. Sometime in March or April, GT Bank shares was like $16. Today is almost $30, if not more than 30. So 100%, 6 months. Yeah, in this country, people are making that kind of money. And I'm not saying you should go in there right now because maybe you probably should have gone in there earlier on, but important to add that stock market is booming. But so why is it booming and what's happening? Well, what's happening is that interest rates are low. There's nowhere for people to put money into. If you're going to put money in bonds, like I said, or treasury bills, you're going to be getting like single-digit, returns. And by the time you factor in inflation, you're basically losing money completely. And that's why the stock market, people are looking at the stock market and okay, like, you know what, those share prices are kind of, undervalued. So why don't I just put money in there and I can get my money out? And the thing is that with a lot of stocks pay dividend. And by the time you do your dividend yield, that's the dividend you get divided by the amount you paid for that share. You probably might be on like some double digit. That's true. So people are looking in that direction and then pouring money in there. Once you're pouring money into stocks, share prices go up. That's what's happening. But you got to be careful what you're buying. Don't buy shares that are too expensive. Expensive shares is not by the amount you pay. It's not whether it's 40 naira or 200 naira. A stock is expensive when the price to earnings ratio is high, especially in double digits. Price to earnings ratio, for example, in simple terms is if you buy something at 10 naira and they pay you, or that thing you bought earns 1 naira per share, right? Its profit is, if you divide it as 1 naira per share, then it means your price earnings ratio is 10 naira that you paid for it, divided by the 1 naira that the company makes as profit. That's 10 times. So it means you're paying 10 times for a share of profit in that company. So there are some companies that their price earnings ratio is 20 times. There are some that is 30 times. So you see, so it means that if your business makes 10 naira, right, per unit, 10 naira per share per annum, and I now buy it from you at 100 naira, it means I'm paying 10 times what your business can make. So is that high? Perhaps. But there are some that are 20 times, 30 times. So that's how you know whether a stock is expensive or not. So you got to be very careful what you're buying. And then, look at the fundamentals as well. So that's basically it for today. If you've got further questions, let me know. Further clarifications, let me know. And then I'll drop some, do some more for you. And probably at the comment section, you can drop comments and then I'll respond. That's it for today. I hope that I've been able to share some sense, some business sense for you. Thank you and enjoy the rest of your day and your week. Bye.